Cap your losses during market crashes. In this educational episode, I'm going to address the question, what happens when you use a multiplier on indexed universal life and the market goes down or loses? Get ready. If you understand this, you will be blown away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades coming up this next year, helping people optimize assets and minimize taxes. But if you've watched very many of my educational episodes on this channel, my favorite financial vehicle to help people accumulate their money tax-free, then be able to access that money tax-free for retirement income, let's say. And at the end of the day, when they die, anything they leave behind blossoms, increases in value, and transfers tax-free, is a max-funded indexed universal life insurance contract. But it must be structured correctly and funded properly. If it is deemed a laser fund to me. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. So I'm assuming you may already understand indexed universal life a little bit to this degree. So let's get into the question, well, what happens if I use a multiplier? So let's start out and make sure you understand indexing. And then I'll talk about multipliers and then the beauty behind multipliers when the market crashes. So here we go. I'm going to simplify indexing for you. When you accumulate money and you're overfunding that insurance contract, you're taking the least amount of insurance the IRS will let you get away with because your objective is living benefits. You want to be self-insured in as few as 12 years to where your cash value equals and exceeds the death benefit sooner than later. And so let's say at a point in time, you've got $1 million of cash value in that IUL policy. You can extrapolate whether it's 100,000 or it's 10 million. But when you have $1 million of cash value in there, let's say that you feel bearish about America and you think we're headed for a recession. Well, I would recommend that you just settle for the general account portfolio rate. Now, back in the 1980s, the general account portfolio rate was between 11 and 3/4 and 15.5%. Interest rates started coming down, and especially after the turn of the century, the general account portfolio is normally around 5%. They need one of those percentage points for them. And so the net would be, let's say, 4% on a 5% gross. General account portfolio, GAP, this is, invested in AAA bonds and sometimes AA bonds and mortgages on shopping malls and skyscrapers and so forth, very little into stocks. And so this is what they're earning on their general account portfolio, which is billions, even trillions of dollars. So you could just say, just pay me the 4% this year. That's $40,000. And that's, of course, better than most banks are, but it's tax-free, so it's way better. And so that's $40,000. At the end of the year, you have $1,040,000, and that's going to compound the next year. But most years in a 10-year period, you'll have 7 gain years compared to 3 loss years. So most of the time, I would recommend linking to an index. And so your money's not in the market. You're linking to an index or indices, and this is how it works. When you feel bullish about America and 7 of 10 years the market goes up, your chances are pretty good. So you're telling the insurance company, hey, you can take the interest on my million, the 40,000, and use it to fund an options budget to buy upside options in whatever index or indices I choose, the S&P 500, the Dow Jones, the Barclays, U.S. Dynamic Balance Index, Russell 2000, whatever, okay? You diversify. And so they take the 40,000 of interest, but your million has to stay safe in the insurance company, earning 4. So they're taking your interest on that, and they're funding an options budget. So if the S&P, let's say, goes up that year 8%, they have the wherewithal, because the 40,000 of options blossoms to 80,000. They can pay you $80,000 on your million tax-free. If it goes up to 12%, they can pay you $120,000. up to a cap. Now, during different time periods, I've had caps of 16%, 17%, 21%, 25%, sometimes no cap. But there's usually a cap. The trade-off is if the market crashes, you don't lose. You may not make anything, but you don't lose your $1 million principal. The options expire worthless. So that's the beauty of indexing. It's not an index mutual fund. So hopefully you understand that. So in my book, The Laser Fund, and I want you to stay with me, I want to gift you a copy of this book free if you just pay for the shipping and handling, and so I'll show you how to do that at the end. But in my book, I'll show $1 million of cash value in an IUL policy like a bucket. And if the general account portfolio rate is $40,000, you can just settle for that if you want. But if not, it can fund an options budget so that the insurance company has the wherewithal to pay you if the market goes up, the gains. But if the market goes down, zero is your hero because you don't lose if the market goes down. Like in 2008 when the market dropped 40%, none of our clients lost a dime due to that market crash. They may not have made much of anything, but they didn't lose. And so the remaining $960,000 in the insurance contract grows at 4% and comes back up to $1 million again. So it's like a break even, but zero is your hero when the market crashes. Now, many people are satisfied with just that, just not losing when the market goes down, and let's just make money up to a cap. There are other strategies. Sometimes you can choose a 1-year point-to-point with no cap, but they'll usually subtract a 5% fee or a threshold at the back end. So if the market went up 12%, they subtract 5, you'd only net 7. So we usually don't use that except when the market does crash. So for example, in March of 2020, due to the COVID-19 pandemic, the market went down 30%. And many of our savvy IUL professionals called their clients and they had them link to a 1-year point-to-point with no cap. Well, the market came up 66.33%, minus 5%. They got credited 61.33% in 1 year. We had one guy that had $852,000 in March of 2020, didn't add a dime to that. March of 2021, that was worth $1,387,000. So we made over $500,000. So you can sometimes do no cap. Well, then what is a multiplier? So here we go. When you use multipliers, and not all insurance companies offer these, but this particular company, you might choose a multiplier and they will charge a 7.5% fee. Now, what this fee is, this is to fund more in the options budget. So based upon what I just explained, if the general account portfolio rate is 4% would be $40,000 on $1 million. And you're saying, you know what, I feel so bullish about America. I think it's going to go up and I want to capitalize on this. So I want to give you more of my money to buy options than the just 4%. I want to give you another 7.5% of my million. That's $75,000. So now they have $75,000 plus $40,000, and that funds a bigger options budget. So what's happening is that when the S&P goes up that year, if it goes up, they will pay you 2.7 times whatever the S&P does. If the S&P just went up 10, you'll get 27%. Of course, you subtract out the 7.5% that it cost you, but you're going to net 19.5%. That would be during a normal type of market. That's a multiplier. But we actually have had people that have used multipliers where when they had the 1-year point-to-point with no cap, those people who use multipliers on top of that, they times the 61.33% by 2.7. They ended up with over 158% return by using a multiplier because they were so confident the market was going to be higher a year after it had dropped 30% due to COVID-19. Does that make sense? Sometimes people don't want to go that aggressive, and so there might be a 5% fee. And the 5% fee for the options budget means that you're giving up another $50,000 on $1 million. So now they have another 50,000 on top of your, let's say 4%, 40,000. So now they have 90,000 to funds an option budget, and they'll pay you usually about double whatever the market does. If it earns 10, they'll pay you 21.4, and then you have your 5% fee that you take off of that. So that's called a multiplier. And like I said, when we have certain opportunities, like in the March of 2020 to March of 2021, COVID-19, the market dropped 30%. This client diversified and had 6,000 in one strategy, 6,000 in another, 6,000 in another. But he assigned 18,000 to the 1 year point-to-point with no cap. And at the end of the year, he got 61.33%, is worth 29,000. But using a multiplier, they would have had a credit of 158%. And so this is the magic behind multipliers. If you feel pretty good about the market going up, this is the person I talked about that had 850 grand. He got 61.33%. He made 535,000. And at the end of March of 2021, he had 1,387,000. But if he would have chosen a multiplier, which many did, he would have had 158%, not just 61%. So the beauty of this is that when you choose a multiplier, I like to sort of compare it to a cap on your losses. Remember, the beauty of indexed universal life is you might make money up to a cap, up to 12% or 16% cap based on the price of options. Well, that's what you can make up to, but the floor is zero. Zero's your hero. Well, if you feel bullish about America, you can say, well, I want to go for it, and I want to make 2.7 times what it does, but I only want to risk a 7.5% loss. If the market crashes 30% or 40%, I want to cap my losses at 7.5%. So that's why I said at the beginning, you can cap your losses when the market crashes when you use multipliers. Now, savvy IUL producers that I train, they know when to alert their clients to participate on maybe a 1 year point-to-point with no cap, because that doesn't happen that often, and also when it would be very good to use multipliers. So I hope that this education has helped you understand this better. If you want to learn more, I would suggest you study my book, The Laser Fund. It's actually 2 books in one. I want to gift you a copy. I'll show you how to get one in just a moment and claim it. But this side is the left brain side. It's about 200 pages, 14 chapters with all the charts and graphs and explanations. If you learn more by stories, you turn it over to this one. And this is about 100 pages, 12 chapters with like 62 chicken soup for the financial soul stories. If you want to use your whole brain, then you read both of these books. This retails on Amazon for $20, and if you go there and purchase it, you're going to pay another probably $10 in shipping and handling. Thank you if you do that, but I'll gift you a copy, okay? I'll pay for the book. To claim your free copy, you simply go to laserfund.com, and I require some skin in the game. You cover the shipping and handling. It's a nominal charge, and then I'll pay for the book. I'll fire up the hard copy to you. Now, while you're in there claiming your copy of the book, there's also options if you like to listen and learn or watch and learn. But there's also educational webinars we teach on a regular basis. They're free. You can even schedule an appointment. You can fill in an appointment slot to talk with an IUL professional if you already are pretty convinced that you want to see how an IUL contract structured correctly, a laser fund, would work in your particular set of circumstances. So claim your free copy, and I'll see you on the other side of your brighter future.